everyone. It's Charity Smith, Miss Mogul. I'm excited today because today we launch Module 3, Buy and Hold Real Estate. Now, before we get into today's lesson, I want to make a couple of announcements as usual. First of all, if you have not done so already, please subscribe to mommy'screatingeconomies.com. It really is the central hub of all that we do here at Mommy's Creating Economies and Mogul U Real Estate Academy. So make sure, one, you subscribe to mommy'screatingeconomies.com and also follow us at youcancreateyourown economy.com. There will more than likely host some of our bigger events, conferences, interviews, etc. So you want to make sure that you're connected with both of those platforms. Also, if you have not done so already, make sure that you subscribe to our YouTube channel. It is Mogul Life TV. Again, that's Mogul Life TV. And you'll see some of our older videos that will also help to educate you not only in real estate, but in leadership, in social issues, just things that are really important to us here at Mommy's Creating Economies. Finally, make sure you connect with our resource center. Our resource center houses all of our ebooks and some of the uploads that will help you matriculate through your education with real estate investing. Also, you will find there our brand new product. It is the Ultimate Wealth Elevation System. I am excited to launch this. This, ladies and gentlemen, will take you from intro to real estate investing to a more intermediate level. It will help you to expedite not only your learning curve, but also get you ready for the market. So you want to make sure you go ahead and go to mommy'screatingeconomies.com /shop and make sure that you pre-order this real estate investing system. I am super excited about it, and I know it will be just what you need to grow your real estate business. So without further ado, thank you again if you've already taken a couple of our classes. We're certainly excited to host you. Make sure that you go through all of the modules. We'll talk about creative finance. We'll talk about buy and hold real estate today, but then we expand that conversation in tax liens, tax deeds, Section 8, and some other strategies that will also go under the umbrella of buy and hold real estate. And we'll introduce a few of those today in this segment. But if you really want to expand your knowledge base in buy and hold, I really encourage you to go ahead and take those modules as well. So now, without further ado, let's get into today's lesson. So let's start here at the beginning. Let's get started. Wonderful. Again, we want to invite you to subscribe to all of our platforms where you'll see all of the other classes that will be hosted here with Mogul U Real Estate Academy. But today, you are in for a treat. You're in for Intro to Buy and Hold Real Estate, presented by myself. I'm the founder of Mogul Life Real Estate, Mogul U Real Estate Academy, and Mommy's Creating Economies. And I'm excited to be with you. Here's a quick video introducing more of who we are to you as our student and hopefully our partner in future events. Welcome to Mommy's Creating Economies, your platform. Welcome to Mommy's Creating Economies, your platform educating you in creating your own economy. Hello, everyone. My name is Charity Smith. I'm the founder of Mommy's Creating Economies, CEO of Mogul Life Real Estate, Mogul U Real Estate Academy, mommy, author, investor, real estate coach, and mentor. I am super excited to introduce this new platform to you. With Mommy's Creating Economies, you will discover real estate investing as a viable career option for you, closing that achievement gap and putting you squarely at the helm of your own success. There are no glass ceilings and no barriers. Secondly, we'll propose new economic possibilities to you in real estate investing where you and your family will grow with the market, whether it's a bull market or a bear market. You are positioned for success. Finally, we are showing women how to invest in their local economies. Subscribe today to Mommy's Creating Economies. While you're there, you'll receive a free download introducing you to real estate investing. Go ahead and RSVP for our upcoming webinars and events. And yes, enroll in class today. I'm excited for your possibilities with mommy'screatingeconomies.com. This platform is here for you. Subscribe and join today. I'll see you at closing. So hopefully now you understand more fully what we're about and you're excited about the collaboration of joining us here at Mommy's Creating Economies and expanding your education with Mogul Life Real Estate and Mogul U Real Estate Academy. Now, if you have not done so already, please take out your phones and go ahead and scan our QR code and make sure that you are connected with us here. We are live now at mommy'screatingeconomies.com. So please join the community. You can also subscribe to some of our social media platforms. You can connect with me at Instagram, Miss Mogul. Please go ahead and connect with the community at large on Facebook at Mommy's Creating Economies. And again, you can connect with me on Twitter at Global Ms. Mogul. So please connect with the community today. Now, let's get into our module. All right. So, what is buy and hold real estate? Hopefully, what you're thinking about when you think of buy and hold real estate, you're thinking about residential markets primarily. That's the market we want to really introduce you to. Why? Because it's the easiest market for you to enter into as a newbie investor. So, when you think buy and hold, most people think about rental houses, lease houses, duplexes, fourplexes, etc., maybe even multifamily. Some of them may think land. All of that can be considered buy and hold real estate based upon the strategy or the use of that property. So buy and hold real estate is a passive investment strategy in which you as the investor buy with the, in this case, the instance is real estate. So it's where you buy real estate. However, the same is true if the investor purchases stocks and other securities and holds them for a long period of time, regardless of fluctuations in the market. That's where I really want you all to kind of focus in on. Buy and hold real estate is when you buy and hold real estate, whether it's, again, residential properties, multifamily properties, land, etc. You are purchasing that property with a long-term investment in mind. So you're not worried about the fluctuations that are happening in the market right now because of COVID-19 and some of the other issues. And I know that some of the smaller landlords have experienced some real fluctuation. But listen, when you have buy and hold real estate, you have options. So whether the market is tanking, if you know how to get value out of that property, that is still a good investment. And we talk a little bit about that in creative finance. So just because the market may be going up and down, it doesn't mean that it's time to sell. What you should be thinking about in long-term real estate investing is how to ride out the market and how to hedge some of your losses with the benefit of having that tangible asset in hand. You can still get income and revenue from it, even if you're not getting rent from it, if you understand the strategies associated with it. So again, that's another class. But buy and hold real estate is really holding that real estate for a long period of time with an exit strategy in mind, but that exit strategy is down the road. Now, here are a few ways to generate passive income in real estate investing. You can purchase stock in real estate related businesses that are publicly traded. And we at Mommy's Creating Economies are going to have some options available for those of you who want to invest in some of the projects that we're doing. We are hosting investment opportunities around the country, and you may not actually want to do the real estate investing. You just want to do some of the profit sharing. Well, we will have those opportunities available for you. Inquire about that. Also, investing in real estate trusts, love REITs. REITs are another opportunity for you to, again, put money into an investment and you may not do anything with it. Those who are managing the trust would now negotiate the activity of the trust, but you benefit in the profit sharing. All of this is in addition to collecting monthly rentals and commercial leases. So that's in addition to that. Now, buy and hold real estate is a tested and trusted long term investing strategy, long favored to create sustained wealth. Newbies should investigate thoroughly the advantages and, in some cases, the disadvantages of buy and hold real estate. So, when you think about investing in real estate long term, I want you to think about time and I want you to think about strategy. In other words, what is the purpose of you having this particular investment? Is it to pay off debt? Is it to put a child through college without taking out any student loans? Is it to take care of health care costs that may be escalating for a loved one or to replace an income altogether? Regardless of that, you need to think about time. How long is it going to take for you to generate or replace an income? Or let's just say that you need to now have a retirement portfolio. You've waited to the last minute to have some retirement savings. If you're thinking about buying and holding real estate, again, what's the purpose of it? How much time do you have? And what strategy or are you going to employ with that particular investment? In order for any, and I say any investment to be successful, you have to know the numbers, ladies and gentlemen. And here's where I want to kind of put a pin in the conversation and spend a little time here. For so long, women, primarily women investors, have not been as concerned with the numbers. Now, before you cringe at that statement, let's look at the facts over a period of time. We have traditionally, women have allowed their investor financial planners, etc., to know about the numbers. If you are married, the spouse traditionally handled, the husband handled those numbers. And it has not always, and again, this is not just a universal statement, but more truth in it than not. We have not been concerned with the numbers. Ladies, because we are living longer, and because we now have more responsibilities for caring for our loved ones, whether it be an aging parent or a child, or maybe you are divorced or you're newly single, or whatever your situation is, the point that I want to drive home, or maybe you're not married yet, you've never been married, you're in college and you're about to graduate, and you want to now generate some passive income on the side of your new career. You have to know the numbers. It's the numbers that makes the investment successful, not just having the investment itself. You have to know the numbers. So I always begin with the after repair value. Now, some may think that, well, first of all, let's deal with what after repair value is. If you're talking about after repair value, generally you have purchased a property that is distressed in some way, whether it is the blight of a community. Maybe you've purchased a residential property that has been sitting vacant for some time and it's in real need of repair, or the property may not be in need of repair, but it's functional, but it needs tremendous updating in order for it to be attractive to today's tenant or today's buyer. Or maybe it's distressed because it's in probate, right? It's an estate property, and perhaps an elderly person has been in that property for 40 years, kept it in immaculate condition, but again, it does not meet today's standards when it comes to floor plans or when it comes to amenities. So when we talk about after repair value, the property is distressed, and I put that in quotes, in some way. So we start with after repair value in order to find out the success of this potential investment. Now, it's helpful because we also have a cheat sheet. And if you would like that cheat sheet on after repair value and understanding how to calculate that, please send us an email and we'll happily send that cheat sheet to you, and also send how to really break it down and understand it really comprehensively. You should also know the return on your investment. What is the ROI cash on cash returns. All of these terms determine how successful your investment will be. So it's not just a matter of you collecting monthly rents, but we'll talk about a little bit further in this particular section what all now goes into calculating that monthly rent. So you may be getting the rent, but you have holding costs that could potentially eat into your returns monthly if you have not taken all that into consideration. All of this data is in addition to you knowing the property's appreciation rate, property tax, and insurance costs. It's all about understanding the numbers and leveraging them for healthy gains. And you'll hear me repeat this. The bottom line here is that the monthly revenue should exceed the monthly expenses specific to that property, such as property or mortgage payments, interest, taxes, fees, and maintenance costs. So we're going to get into holding costs a little bit later, but the point I want to drive home time and time again is that your monthly revenue should exceed those expenses in order for you to have a healthy return. Now, I'm going to talk a little bit here about the after repair value and kind of give you some insight on how to calculate that. Again, knowing your numbers, and here are some calculations you want to familiarize yourself with. ARV is the after repair value once you calculate what that is, right? And when we talk about after repair value, how much are the repairs on the property? How much are any fees that you're paying the realtor if you're using a realtor? If you're hosting this on a website that may have a monthly fee for you hosting this property, what is all of that? Then multiply that times 70%. Then subtract your estimated repairs, and that should equal the maximum purchase target. Okay, so after repair value, use the ARV, the after repair value calculation, and the 70% rule when buying your property in case you choose to sell it at a later date. Now you're thinking, we're talking about buy and hold real estate, so why do I need to know after repair value? The reason you need to know that is because each time, and you'll hear again me drive this home each and every time, when you buy a property, you need to have an exit strategy in mind. Even if you're going to hold that property for 5, 10, 15, or even 20 years, depending upon what your options are, you still need to have an exit strategy. So you buy the property with after repair value in mind, and you buy smart that way. Okay. You don't want to pay more for the property than you need to, because at some point when you sell it, you always want to sell at a profit. But the only way you sell at a profit is that you buy smart. Okay. Here's a note for you. The 70% rule is a way to help investors determine the maximum price they can pay for a property in order to turn a profit when selling the property. And that's what I just stated to you. The rule states that an investor should pay 70% of the after repair value for a property minus the necessary cost of repairs and improvements. Okay. So again, you always buy a property, even if you plan to hold it long term, you always buy a property with the exit strategy or selling it in mind, depending upon what your strategy is. Now, when you're doing your calculations, make sure you familiarize yourself and know the cost of holding a property. This is one of the cardinal sins that many newbie investors do not take into consideration when purchasing a property. Okay, how much does it actually cost to you to hold that property before you lease it, or while you're leasing it, before you sell it, while you're waiting on some transaction to happen? There's still costs associated. So make sure that you are familiar with these potential expenditures and familiarize yourself with them. You're going to need homeowners insurance many times, especially if you're financing this with a bank. Now, if you're not using a bank, you may not need homeowners insurance, but it makes sense to have it. And in some cases, flood insurance, especially if you've been in, for example, we're in Houston. We had the 500-year flood with Harvey, and it caught so many investors and property homeowners off guard because they thought, well, we have flooding, but nothing like what Harvey had, right? So many times you'll need homeowners insurance, and in some cases you may need flood insurance as well. Depending upon where you buy the property, there may be HOA fees, homeowners association fees involved. And listen, if you don't pay those fees in states like Texas, your property can be foreclosed on. Okay, so you have to pay the HOA fees. Property taxes are also there. And again, depending upon when you buy, you may be responsible for purchasing, pardon me, for buying the property and then paying the property taxes once you purchase it, depending upon how you structure the deal. There may be liens, okay? Liens on the property. So let's say that you bought the property and it didn't have a clean title to it. There may be a mechanic's lien or a roofing lien or a plumber's lien on that property. And you have to pay for that in order to have full use and ownership of the property. There are also repairs, administrative salaries. So if you have a virtual assistant who is helping you with all of your administrative costs monthly, advertising this on social media, on realtor.com, Zulu, and some of the other sites, or even mommy'screatingeconomies.com, there may be administrative costs. Property management costs may be associated with this as well. So if you don't want to handle the day to day or the month to month features or repairs of this property, you may need to have a property management company who oversees the functions of the property. That's a cost. Again, repairs. I keep going back to repairs because depending upon where they are and how major they are, it may be a roof, it may be a major foundation overhaul. That's another repair. Realtor commission. Okay. Now, while we love to work with realtors, we love them in our community. Sometimes you can use them and sometimes you may not need to use them. But if you do, you need to calculate their commission in. And let me tell you this, a plug for the realtors, because I have a license as well. If you ever find a realtor who really works well with you, keep them working and make sure you're always calculating in their commission. If you get a good one, they are worth their hire. I'll say that. The cost of vacancy. How much does it cost you not to have this place occupied, right? And all of these costs can go into the cost of vacancy. You may have utilities, right, that you have to take care of. So in order to have someone looking at the property or do your showings, you have to have the lights, the water, the gas on. That's a monthly cost. And of course, the cost of marketing the property to either get it leased or get it sold. So all of these components go into the cost of holding the property. Okay. So you not just about you collecting a monthly rent. How much of that rent do you get to keep after all of these costs have been taken care of is the question. All right. Hmm. Kind of hung here on our screen. Not sure what is happening here. This is interesting. All right. Pardon us here, ladies and gentlemen. We have it there. Oh, wow. Okay, so let's go back. That's interesting. Not sure what's happening here. You all, with technology, anything is liable to happen. So let's see here. Wow. Okay. Sorry about this, ladies and gentlemen. We're having a bit of here we go. All right. So let's go back. We talked about the cost of holding a property. So now let's go to the next slide. Pardon us for that. Pardon me for that. Not sure what's happening with our system here, but nevertheless, here we are. Now, here are the calculations you need to familiarize yourself with. And if you're writing down a resource that you really need to make use of, especially as a newbie, I'm going to take you to it. Here is a resource that is for free that you can use to do some of your calculations when you are calculating the cost of either buying a property, holding a property, monthly costs. Here we go. It is calculator.net. Okay, it's calculator.net. It is a free resource that I highly recommend you use. And when you go to this resource, it'll help you with what should you pay in purchasing a property? What is the income you can expect from a property? What are, and here is what we were just talking about, the reoccurring operating expenses. How much does it cost you to sell the property? All of that goes into um, knowing your numbers. And here's again a free resource. So if you don't have a calculator on hand, just to have your phone or whatever, and you don't know all of the formulas, you can plug numbers in to this particular resource and it does the calculations for you. And I'll show you right here. So let's use monthly income, right? So we are looking at, um, let's say we're looking at $1,300 a month. Okay, we don't have any other income from that property. Well, let's just say that we have, say, a washateria on site. Again, that's old school. Most units now have the washer and dryer unit in the property, but let's just say that we have an old school situation going on and we get $150 a month from people using our on site washateria. All right. Now, let's also look at the cost of purchasing this property was $100,000. We took out a loan, put down 20%. The interest rate, let's look at a more accurate interest rate. With great credit, you can probably get an interest rate now at 2.5%, 30-year term, closing costs $3,000. Doesn't need any repairs. Okay, and now we're looking at monthly income. Let's look at reoccurring costs. And these are already plugged in just for the sake of example. Property tax, $1,500 at 3%. Total insurance, $800 at 3%. HOA, and let's just say we have an HOA of $250 annually. Okay, maintenance costs, and that could be again your property management company. It could be the person you hire to take care of your lawn service, cleaning the property if you have a concierge service, etc. Now we're looking at, do you want to sell it? No, we're going to buy it and hold it. Now let's look at what the calculation is. Okay, now it spits out the calculation for us. The total profits when sold is $13,000. Cash on return, 56.61%. Capitalization rate, 12. Not bad. It could be better though. These numbers could be a lot better. Okay, but we're not talking about those numbers right now. Oh, look at this. So was this a good buy? Look at where the cash flow is. Negative cash flow. So is this a good purchase? Not right now, because that means you need to adjust then how you've bought it. You need to adjust then how there are some adjustments, in other words, that need to happen. Either you didn't buy it well, you overpaid for it, you're not collecting enough rent, but there's something that's happening there that has brought in a negative cash flow. That's the death of your business. So you want to make sure that you buy right. That's another class that we'll get into. But in other words, I want to show you that there is a resource out there that helps you with purchasing a property before you do it. So before you sign on the dotted line and you finance or you go and get that money out of your self-directed IRA to self-fund your purchase, you need to see now what the numbers need to be or where they are now and how you can adjust something to get a positive, healthy cash flow. Okay. Again, the bottom line here is that the monthly revenue should exceed monthly expenses. All right. And if they don't exceed monthly expenses, it's not either time to buy that property or you haven't held it enough, but there is some kind of adjustment, whether it's in the mortgage payment, the interest, the taxes, the fees, something needs to be adjusted in order for you to have a healthy monthly cash flow. In order to buy and hold property and be successful, investors must identify what the area, right, of where this rental property will be. Appreciation is what you're looking for depending upon your objective. And I would say, in any case, you want appreciation on your property. This will help you minimize risk and undermine your profitability in that investment. So, depending upon where you buy, is just as important. So, let's recap right quick. First of all, you need to know your numbers, know your calculations, because it is the life and death of your business. Secondly, you need to understand market analysis. Where you buy the property is just as important as how you buy the property. All of that goes into market analysis, okay? So you want to look at the area and identify an area with promising rental market income. You also want to make sure this is an area that will appreciate over time. All right, so let's get into this a little bit more. Let me go back a little bit and talk a little bit more about market analysis. So many times, newbies, here's another mistake that many newbies will make. You will see a property that's online and it's cheap, and you're excited because it looks affordable. You're thinking, yes, I can buy this property cash and I don't have to worry about getting a loan for it. I can self finance and we can move forward. I want to caution you on only looking at how cheap a property is. When you purchase these properties, make sure when you're doing your market analysis, you look at a couple of things. And many times, Zillow, Realtor.com, and some of the other sites will have this as well. You can look at the crime rate in the area. You can look at how many properties have been bought and sold in a 5 mile radius around the property you're interested in. If there is no activity around that property, I would say you need to reevaluate whether or not this is the time to buy that. Now, here is the caveat. If you see where an area has been depreciated for some time, but now new interest is coming in, maybe in a 5 to 10 mile radius, and folks are starting maybe to develop there again. It's not all the way back, but businesses are coming back. Houses are being revitalized and rebuilt. Maybe a park is there again, a bus stop, a new traffic light. Believe it or not, that's an indication that revitalization is coming. Or if you see a new road coming through an area that has been depreciated over time, that may be a good time to buy. But you want to see what activity is happening there. So if it's a high crime area and there's no buying or selling, rethink buying in that area. However, and I don't advocate buying in areas where there is really high crime. But let's just say you have no purchases, no buying and selling in a market, but there's a high rental market there. It still may be okay to buy there. And if your strategy is buy and hold, it just makes sense. That means that the population in that area is really connected to renting. They really, and that renting could be Section 8. Don't knock it till you tried it. We'll talk about Section 8. That's a whole class that is devoted to Section 8. But Section 8 housing is steady monthly income that comes to you direct deposit, and you don't have to worry about it. Now, you may be wondering about the tenants there. It's one, how do you filter your tenants? And what does your lease look like? You can filter all of those dynamics so that you have a more desirable population your in your residence. So don't shy away from Section 8 housing. It's a good deal. So look at a few things when you're looking at market analysis. Look at the value of the homes there. Look at how many have been bought and how many have been sold. What is the rental market there? What are the property taxes in that area? Because you don't want exorbitant property taxes. They'll eat into your profitability annually. You'll also want to look at amenities, right? Is it a desirable area? Is there a school, a park, public transportation there? Is there a Starbucks there? Okay. When you see things like that coming into an area, it's a good indication that the area is making a positive turn, and you definitely want to be there for that positive turn. So a few things to consider when you're looking at market analysis. Okay. Now, there are 4 steps to buy and hold real estate the right way. I'm going to encourage you to see your beginner's guide. It comes with this class, by the way. See your beginner's guide to buy and hold investing for sections on financing and buy and hold deals. And we also recommend that you attend the creative finance class as well. There are some sections in the guide that I do not cover here in the presentation, but when you connect the two, you have a more comprehensive overview of buy and hold real estate. Okay, so make sure that you make good use of that beginner's manual. 4 steps to buy and hold real estate the right way. First of all, it goes back to what we were just talking about. Find the property, okay? Focus on areas with growth trends that are revitalizing. I'm a big proponent of buying in historical areas and having an impact on gentrification. So if you want to buy well, I say look at areas that are gentrifying and buy there. And now you are part of the growth of that community, and you have some say so in what happens in that community. And listen, again, here is another place I'm going to put a pin in the conversation. As investors, we are business owners, okay? So your property is a business in that area. You want to have an impact on the quality of schools, the quality of utilities there. Attend some of these meetings that are held by the city and make sure that you're voicing your concerns about crime, about picking up trash in the areas where you're investing. All of that goes into whether or not your area is desirable, the quality of tenants you're able to get, and also the well-being of your investment in that area. So if the area is on a perpetual decline and you can only get the worst of the worst when it comes to tenants, you don't have the best case scenario in your investment. And a lot of that has to do with the area that you're in. So make sure that you're not leaving those discussions only to city council or only to those utility entities. Make sure you attend some of those meetings. Okay, so now make sure you're looking again for areas that are revitalizing. Look at the layout of the property from the eyes of a potential tenant. So it's not just about buying cheap, but does this property now host the lifestyle of a contemporary tenant? Most tenants don't want to have a bunch of walls in their properties. That's not a current floor plan. Many would prefer an open area. 3 bedrooms, 2 bath is the standard, with a 2-car garage. But again, that's depending upon what part of the country you're in. We also invest in parts of the country where smaller bungalows are really desirable. 2 bedroom, 1 bath do really well with first time home buyers, with college graduates, with student housing, depending upon what your goal is. So again, it depends upon where in the country you're investing, but you want to make sure that the floor plan is attractive to a contemporary tenant. Here's the question I ask. Would you want to live in this property? Now, it doesn't mean that you have to go and spend thousands of dollars on granite countertops and faucets, etc. But you do want to update the property well enough so that the tenant has a sense of pride in the property. Okay. So if you would want to live there, chances are your tenant would want to live there as well. Now, I'm going to tell you, it's a fine line between updating the property to your standards versus updating the property so that it is profitable in business. Make sure you go back to calculator.net, look at those numbers, and do not over improve for the area that you are investing in. If I could give you any pearl of wisdom, that would be one. Do not over improve, but then don't under improve either. Okay? Goes into the conversation. Upgrade the property. You must add value to buy and hold properties. By no means does this mean renovate the property outside the profit margin. Did I not just state that? So don't over renovate the property outside of what's going to keep it profitable. Make sure you go back and you see where the numbers were negative. Something went wrong there. Money was not allocated properly. When you update a property, it should not eat into your profitability margin. Okay. If it does, you're going to have to hold that property a lot longer and make some adjustments in some other areas so that you can now recoup what you've lost in profitability. Okay, but make sure that you upgrade your property and make sure that you have an environment that your tenants would want to stay in long term. Manage the property. Nothing worse than a slum lord landlord. That's not what we advocate here whatsoever. Okay, there's a good amount of time, effort, and patience needed to run a rental property. So, for all of you who are looking at HGTV and thinking it's simple, it's wonderful, and they get it all done by the end of the episode, that's not realistic. Buy it and take it from me, the buy and hold queen. Okay, that's not realistic. Now, buy and hold is where you leverage and you start to build more wealth, but you have invested a considerable amount of time and patience in that investment as well. Long-term rewards are great, but getting there takes management skills and the right team members in place to construct a well-defined system for renting. That means your numbers are there. Your CPA or your tax person is on point. Your VA, your virtual assistant, is keeping all of the administrative entities rolling. Your property management company is on point. And if there is a repair that's needed, they don't delay in that. They get to that as soon as possible so that the tenant does not become disillusioned with the property. Okay? Because a disillusioned tenant means that you're going to have low occupancy and high vacancy, the antithesis of what we want in buy and hold real estate. Your job is not to answer every request of your tenant. Your job is to build a business and an investment portfolio. And let me tell you all, when I started out in this, I can honestly say this is one of the biggest mistakes I made managing my own properties. It will run you ragged. It's a great learning experience. So if you have the patience and if you have maybe the family or the time to do that, it's a great learning experience. But when you can leverage and get a management company, I highly recommend you do that. Prepare for the unexpected. Now, again, this goes back to the conversation I had about Harvey, Hurricane Harvey, Flood Harvey, 500-year flood Harvey. Many of the people in the state did not prepare for Harvey because we had never had a flood like that before. But as a property manager, or not property manager, pardon me, as a buy and hold investor, you need to prepare for the unexpected. Okay. It's important that you maintain a healthy reserve fund to brace for unexpected occurrences that lead to potential and leads for potential tenants. Without reserves, you will be forced to scramble and get financing to pay for these items. So, God forbid you have a pipe burst in the winter. That's completely foreseeable in places like Chicago, Minnesota, Connecticut, some other places. Or you may have bought an old property and you have not updated the plumbing system yet because you were told by the inspector that you have a couple of more years, but for whatever reason, a pipe burst. You need to have a reserve on hand so that you can properly take care of that property and it doesn't decline quickly. Delayed repairs lead to delays in revenue. Okay, so if you're taking notes, that's a good place to write something down. Delayed repairs lead to delay in profitability. It also leads to a high vacancy rate. Don't do it, don't do it, don't do it. But you need to again have money on hand so that if something unexpected happens where you have a pipe burst in the ceiling and you get a leak, you can repair it quickly and again keep that business, which is your buy and hold property, keep that business liquid and financed and occupied. Okay. Now, I had the slide in another presentation, but I wanted to just interject it here as well. How do you prepare to real estate, to invest in real estate? All of these are important. It's about changing your paradigm. It's about taking inventory of your assets, calculating your credit standing, getting a business name, a tax preparer, opening a business account, and deciding on strategy and making offers. But it's also, let's just say that you're not going to self finance and you're looking at financing with a bank, or you want to go a lot bigger in scale. So, preparing to invest means that you have the right partners at the table, the right lending partners at the table, the right investor partners at the table. You have the right attorneys at the table, especially if you're looking at large sums of land or portfolios that could get into inheritance issues. And there's just a plethora of things that could happen when you have a large scale project in play. You need the right attorneys. If you need some referrals, please reach out to us. The right mortgage companies, the right lenders, the right tax preparers, the right CPAs. You need all of these people at the table before you begin to invest, in my opinion, especially if you're looking now to scale. Now, if you're just starting out as a newbie, all of the things that are listed on this slide here work. Adjusting your thinking, taking inventory of your assets. And again, we list them here: life insurance with cash value, IRAs, particularly self directed IRAs and retirement funds, savings, checkings, dormant property that you can now flip into a buy and hold asset. All of that can now prepare you for real estate investing. Evaluating your credit, making sure that you have the optimal credit score so that even if you don't want to go out and get money right now, if you have a good credit score, you have better interest rates and you now position yourself to get better free money. We'll talk about that in creative finance. So all of that is important, okay? Take advantage of what we're listing here and then do the work, ladies and gentlemen. The whole point of this is to get you ready to invest in the market. And I predict that because of COVID-19 and because of some of the issues that have happened with tenants and leasing in 2020, many of the issues will roll into 2021. People won't be able to catch up on their mortgages, unfortunately. Taxes, property taxes will get behind, unfortunately. People will be looking to now move from one leasing situation to another leasing situation. All of that spells opportunity for the investor. It does not spell out taking advantage of people, but if you have the right strategy in place, you can profit handsomely in a situation like that while being a problem solver for someone else. And that's exactly what we advocate here. Now, here's where I like to give out free gifts, okay? If you would like to get a free gift from us, preparing for a loan or getting your credit organized, we have a free gift here for you that's valued at $297. And the gift includes credit repair tools, calculators, strategies to increase your credit score and get you loan ready. It also shows you how to do debt elimination step by step and secrets to getting a loan for your investment. So if you would like that free gift, make sure you are registered for your classes and reach out to us. Register for all of the classes. Reach out and say, yes, I want that free gift valued at $297, and we will get it to you. Now, I promised you all at the beginning of this that we would talk a little bit about strategy and particularly in buy and hold. And I'm going to introduce tax liens and tax deeds in this particular conversation. So now that we've talked about buy and hold, and we've talked about understanding the numbers, and we've talked about market analysis, and then we talked about preparing to invest, okay? Knowing the numbers, knowing your strategy, knowing the purpose of that particular property, let's talk now more about how you can actually enter the market and buy and hold real estate. Now, you can build a buy and hold portfolio with little or no money down. Again, you've seen this slide in another presentation, but now I really want you to tune into this strategy because here is where we talk in depth, more in depth, I should say, about buy and hold real estate. And we get really into the meat of this in the actual tax liens class. Now, one strategy to become a buy and hold investor, especially as a newbie, that I personally recommend is tax lien investing. It's another strategy, again, that requires little to no money out of pocket. And let me tell you how it works. Again, tax lien investing is where you pay for the taxes on a particular property, right? That's either with your tax collector or the tax assessor's office, depending upon how your county names that particular entity. But what you do is, and make sure that you can do this, but you pay the taxes on a particular property and you give the owner, the actual owner of the property, an opportunity to pay you back. Now, tax lien investing does not automatically give you ownership of the property. This is just an investment strategy, okay? It's where you pay for the taxes on a property and you pay for all of the outstanding fees, etc. And you give the property owner a time to reclaim that property, okay? Um, During that time, they have to pay you back the full investment, meaning everything that you paid for that property, all of the back taxes, they now have to pay you for that at an interest rate. Okay. Now in Texas, we have an interest rate of 25 to 50% on penalties. So they have to pay you back. And let's take for the sake of example on the right hand of the screen, the tax lien is $10,000. So the property owner is back. Okay, they owed over $10,000 in back taxes. The state of Texas, in this example, would charge them 25 to 50% on the penalties. You can pay that tax bill over a period of time, and then that person would have to pay you back that money. So if you pay the $10,000 back, before they can take the property and reclaim it, they have to not only pay you the $10,000, but now they have to pay you 25 or 50% on that $10,000. Okay, so you pay the 10, but in order for the property owner to get the property back, they have to pay the 10,000 plus 25 or 50% plus attorney's fees and anything that could be outstanding on that property before they reclaim it. Now, here is why I like this particular strategy. If the property owner, for whatever reason, does not pay back the entire loan, well, it would be a loan essentially, but they don't pay off the lien, meaning they don't pay back the 10,000 plus the 25 to 50% plus the attorney's fees. If they don't pay that back in the time allotted by the county, then you own that property. Okay, so that means you could get a $90,000, $100,000, or whatever. You could get a property for pennies on the dollar by doing this particular strategy. Now, if you were to plug this into the calculator, if you buy the property at 10,000 and you're getting $1,300 a month in residual income, and if you have low enough maintenance fees and VA fees and property management, or you can find a way to adjust that, this is a huge win-win for you. So not only do you get a property for pennies on the dollar, but now more than likely you have equity in the property once you upgrade it. So you purchase the property for 10,000, but if you put $15,000 in upgrades or $20,000 in upgrades in the property, and it's valued at $120,000 or $90,000, whatever, after you've upgraded it, all of that money now becomes equity built into the property, and you've only invested $10,000 in the property. So not only do you have equity, but now you have a property that you're getting residual income from, okay? And you could potentially get tax write-offs at the end of the year, depending upon how you've structured the buy of the property. So there are so many benefits to doing tax lien investing. And if you know, that's the best case scenario. The usual case scenario is you get money back on the investment. And here's why I like this. If you put your money, let's just say in a bank or in a 401k right now, there is no way you're getting 25 to 50% return on your money. But if you invest in tax liens, you get 20, 25 to 50% return on your money. That's huge, especially when the savings accounts right now are running at 0.2% or less. And who knows what I can't think of right now what the 401ks, what the rates are on that, but it's nowhere near a 25 or 50%. Okay. So hopefully you're seeing now that's a huge strategy for you. Tax deed investing is where you essentially engage in the same set of activities with tax lien investing. But if the person does not pay off the property now, you have the actual deed up front. Okay. So it's not like waiting on the person in the tax lien. So in tax lien investing, they can pay it off. All right. And you have the property and you get it and free and clear. And that situation is the same thing. Tax deed investing gets right to the heart of the matter. You are buying the deed, not the lien. In tax lien investing, you're buying the loan, right? You're loaning the person the money, and then you're expecting them to pay you back with interest, etc., and so forth. However, in tax deed investing, what you're doing is saying, "Hey, here's this money, and I'm going to wait for this to happen." And if the person does not pay off their penalty in time, you own the deed free and clear. Here again is where you can have the same set of good outcomes with this property. You get the property for pennies on the dollar, you rehab it, you have built in equity into the property, and you can now get residual income from leasing it. You can then take the equity out of this property, is another strategy that I love. Take the equity out of this particular property where you pay pennies on the dollar for it. And let's just say now you have $80,000 in equity in the property, just throwing out numbers. You can take that $80,000, put it down on a fourplex, and now rehab that and have multiple streams of income coming in. So now, if you have the property, the income from this one property, you take the equity out by a fourplex, now you potentially have five streams of income coming in. So, are you beginning to see now why buy and hold real estate is where you build wealth? Because you still have the tax write offs. You can still appreciate and depreciate the property. You get equity out of the property, and it helps you to scale a lot faster. Okay, so that's another reason why we love buy and hold real estate. Now, hold on. I talked a little bit about this already, so I'm not going to spend a lot of time here. But buy and hold real estate is really you being a landlord. You can be a hands on landlord, or you can have a property management company. But what we want to really drive home is that this is a game changer. Buy and hold real estate is where you leverage and scale quickly. It's quite different from buy and flip. Buy and flip, you buy it. Once you flip it, meaning you sell the property, that's it. You get nothing else from that property. Once it's sold, it's out of your hand. You don't get any more income from it. When you buy and hold real estate, not only do you get the money from your residual income, but you get the money up front when you buy. Remember, buying smart is where you get the returns. So if you have a property that you purchase for $10,000 with a tax lien or tax deed, you appreciate the value by upgrading it. And then you take the equity out of that property and go buy a fourplex. You have just scaled exponentially in what you get now in residual returns, in write-offs, in tax breaks, and it just goes on and on and on. So here is where we change the narrative. When you become a buy and hold investor, this is where you get game changing options, and the opportunities are just endless. So again, this is why I love buy and hold real estate. Have you considered Section 8 leasing? Now, here again is another strategy that I personally employ and I like very much. And I've been able to help many of my clients with their strategies using Section 8 housing, Section 8 investing. Now, here's why I like Section 8 investing. You know what's needed up front for the repair. Many times, Section 8 housing is there's no realtor needed to get this particular property leased. You just have to contact the housing authorities and agencies and say you have a property that's available, and they will put out a list to many of the people who are on Section 8. You show them the property. If they like it, you sign what's a voucher. It's called a voucher. You turn that into the housing authority. The person moves in, and if your house meets all of the inspection requirements, you get money month to month to month. And this is a way for you now to kind of scale back in your overhead. So you may have a property management company manage this particular property, or you may not. Many of these tenants are able to kind of take care of things on their own because of the way the property is set up. So it's easy living. Secondly, you don't necessarily need a VA for this one, because as long as the voucher is set in place and it's with the housing authority, there is no updating, there's no marketing of this property. None of that comes into play. As long as the person is happy in that property, they're not tearing up the property, you got the place that's meeting the expectations of inspection. Many times, Section 8 tenants stay for years at a time. And so, this is a way for you to get, again, residual income on a month to month basis that's guaranteed many times, unless there's something happening with the government, like we saw the government shutdown. That was an anomaly. Traditionally, this money is in your account on time. You're not running down a tenant for anything. That money doesn't even go through the tenant, it goes directly from the housing authority to your bank account. All you do is keep the tenant happy, keep the place meeting expectations with yearly inspections, and it's done. I love Section 8 leasing. I encourage you to really look at it as a strategy. Now, here is another way that you can buy and hold real estate. This is one of my latest projects. You can buy and hold land. I was blessed to negotiate 5.67 acres for $13,000 below the original price, and it will be a new development at some point. But in the meantime, there are strategies called land leases. Okay, so if your property is cleared out, you can lease this land to a farmer. You can lease it for a parking lot. If you want to clear out a section and pave it, you can make a parking lot out of it. You can put a sign, a leasing a cell phone tower on the property, and the cell phone company now leases your property from you for substantial monthly leases. So buying and holding land, we'll talk about this in another class, is another way for you to buy and hold real estate and have some substantial income coming from it. And it's really cheap. So if it's undeveloped and it's just a parking lot, you don't have to pay many of the taxes and some of the other things that come into play when there's a property on it. So again, buying and holding land, great strategy. We love it. So if you want to see some examples of our rehabs, I encourage you to go to mommy'screatingeconomies.com, click on services or scope of work, and you can see both. Okay, see what we do and how we can help you do it, and then go to scope of work, click on that, and you can see some of our rehabs as well. We encourage to see what our clients have had to say about our services. You can see that at mommy'screatingeconomies.com. And also, we'd be happy to send you some of the reviews. We are excited about what our clients and what our students have to say about us. They are repeat and return clients, and we love that. It's because they get not only the knowledge, but the support they need to close the deal. We want to do that for you as well. Go to mommy'screatingeconomies.com for that information. This brings us to the close of our class. And so we have a few more announcements for you. Again, if you have not done so already, please go to Mommy's Creating Economies on Facebook and connect to us there. Register for the next upcoming class. And if you want that free resource valued at $297 that helps you with credit preparation, getting you ready for a loan, actually walking you through steps. And this is like nothing else, okay? It shows you from the banker's perspective what they're really looking for so that you're not going into that process blindly, okay? I really encourage you to reach out and ask us for that free resource. Register for all of the classes, and we will be happy to give that resource to you. Then subscribe to mommy'screatingeconomies.com. Subscribe to our website. Go to our YouTube channel, Mogul Life TV, and request all of your free downloads. So that brings us to the end of our section. Hopefully now you have a better understanding of what buy and hold real estate is all about. Okay, let's get it here. Awesome. So, what I'm hoping now is that you have found a strategy that really works, several strategies under the umbrella of buy and hold real estate. So, there's more than just buying a house or an apartment complex or a duplex or fourplex and just thinking you're going to get rent from it or thinking you can do some self repairs and make money from it. No, you've got to one, know your numbers. Well, let's start at the top. Buy the right property, whether it's a 3-2, meaning a 3 bedroom, 2 bath, or it's a 2-1, whatever it is. Make sure that the property you buy is what's in demand in that area. Buy the property. Then how you buy it is just as important. Okay. um, it's almost more important than what you buy. How you buy it is important. So if you are going to get a mortgage to purchase that property, that mortgage has to now be calculated into the holding cost of that property. Holding costs are not limited to just the mortgages. Remember, it's HOA, it's property taxes, it's liens on the property, it's advertising and marketing, it's property management, it's your administrative costs or your VA costs. All of that goes into buying and holding the property. The rule of thumb is to use the 70% rule. I'm doing a bit of a recap for you. 70% rule. When you buy this property, always buy with the intent of selling it at some point, even though it's buy and hold. Buy at 70%. At some point, you may decide to sell this property. You may move or have a change of life event. Something may happen, and you decide you want to sell the property. Well, you have to have bought it the right way in order to profit from it when you sell it. So use that 70% rule when you're buying the property. Do your market analysis. Is there high crime in the area? Is there high rental rates and high rental turnovers? Are people buying and selling in this area? Is the area in a revitalization mode? All of that comes into play. All right. Look at if they're having new roads and freeways go through the area. Starbucks, if there's, and I'm not plugging them as a business, but when you see a Starbucks in an area, it tells you something about the direction of the neighborhood. It's going on an uptick. And you definitely want to be in on the ground floor of an area like that, because when it appreciates, when it goes up, your property will be in demand and you can now adjust the rental rate to now accommodate that. Okay. Also, know your numbers. Use calculator.net and really become intimately familiar with your numbers. It is the life and death of your strategy. If you don't buy it right, if your maintenance fees are not right, then you can have this beautiful property, but if it's bleeding every month, end of the year, it's not working. Okay, so it's not wealth building. As a matter of fact, it's having the opposite effect. So make sure that you and go to your guide, your beginner's guide, and then include that beginner's guide with this video, and it should give you a more comprehensive introduction to buy and hold real estate. So that's my time for now. Thank you so much for your attention. Sorry for the technical difficulties, but hopefully you were able to move right on through that with us, and make sure you register for the next class. All right. As always, remember, ladies and gentlemen, you can create your own economy. Goodbye until the next class.